Imagine you're at a bustling marketplace. Stalls are stacked with all kinds of goods, each one vying for your attention. As a wise shopper, you wouldn't just buy the first shiny thing you see, right? You'd carefully inspect each item, maybe even haggling over the price. Well, that's exactly how Warren Buffett, the legendary investor, approaches the stock market. But here's the twist. Before you invest in any company, you need to know exactly what to look for. Warren Buffett always says, invest only in businesses you understand. Understanding means digging into the numbers, the financial health of the company. So let us peek under the hood with 3 financial ratios that Buffett and many smart investors check before buying any stock. First up, the price-to-earnings ratio, or PE ratio. Think of this as the price you're paying for each dollar of the company's earnings. Let us say a stock price is $100 and its earnings per share is $5. The PE is 20. A low PE can mean the stock is undervalued, but sometimes it signals trouble. Imagine a company has a super low PE of just 5. While it might seem like a steal, there could be a reason the stock price is so low, like declining profits or a bleak future. Buffett looks for companies with a reasonable PE compared to their industry. For example, Apple's PE in 2024 is around 25, showing the market values its earnings highly but reasonably. Next is return on equity, or ROE. This shows how well a company uses its shareholders' money to generate profits. A high ROE means the company is efficient and profitable. Picture this. You have $1,000 and you invested in a company. If they generate a 30% return on equity, that means they made $300 in profit for you. That's a pretty good deal, right? Buffett usually looks for companies with an ROA above 15%. Take Coca-Cola. It has an ROA of about 30%, meaning it generates 30 cents of profit for every dollar of equity. That's why Buffett loves it. High efficiency, steady profits. Third is the debt-to-equity ratio. This tells you how much debt the company has compared to its own equity. Think of it like your personal debt. If you have a lot of debt, like a mountain of credit card bills, it can be risky. Similarly, if a company has too much debt, it could be shaky ground. Buffett prefers companies with low debt, usually a debt-to-equity ratio below 0.5. For example, Berkshire Hathaway's debt-to-equity ratio is around 0.3, showing a strong balance sheet that can withstand tough times. But remember, numbers alone aren't enough. Buffett also studies the company's business model, competitive advantage, and management quality. He wants to invest in companies that have a clear moat, a strong advantage that protects them from competitors. That could be a trusted brand, patented technology, or a unique service. So the next time you're tempted to invest in a company, be like Warren Buffett, the wise shopper. Don't just dive in headfirst. Take the time to examine the financial ratios, understand the business, and assess its long-term potential. Using these 3 ratios, PE, ROE, and debt to equity, gives you a solid foundation to evaluate any stock. Start applying this today, and you'll think more like Warren Buffett. Subscribe to my channel for more investing wisdom that helps you build real wealth.